Is the market efficient? Well, back in business school, we studied the efficient market hypothesis. Now, this is just a hypothesis. It's just what the opinion of many people believe, that the market is efficient. I believe the market is about 80 to 90% efficient, and it's basically the efficiency, meaning that all the information is out there. That's what efficient means, that all information is known. And so when you think about fundamental analysis and the fact that the market tends to be efficient, by using trend following, where you're following the movement of these large funds who control 80 to 90% of the volume on the exchanges, they all use something called a discount cash flow model, which is a valuation method used to estimate the value of an investment based on expected future cash flows. So these institutions are doing all this important work. So it really is almost in a way a waste of time to do fundamental analysis, because if you do trend following and if you believe that the market is efficient, then you can see what's going on basically in the charts. Now, Benjamin Graham says successful investing is about managing risk, not avoiding it. So when you're managing a portfolio, you got to pay a lot of attention to position sizing. I think the most important thing I've learned is that if I feel that I have made a mistake on an investment, cutting my losses quickly has probably been one of the most important lessons that I've learned, because I retain my capital, I keep my capital safe, but more importantly, I can sleep at night and my mental capital stays strong. Louis Rukeyser was a great host for the show Wall Street Week. Came on Friday nights. My grandfather and I would watch it religiously. Really missed that program. It was a great program. Now, we've been hearing a lot about IPOs, and Ken Fisher has an opinion on this. He calls an IPO, instead of an initial public offering, he calls it's probably overpriced. So when you think about the structure of a deal, it's really to the benefit of the sellers that are bringing the stock to the market. So he basically says initially it can be a loser's game. About 80% of IPOs stumble, faceplant, or underperform the broader market within the first 1 to 3 years due to inflated initial hype. Now, the SpaceX deal we'll talk a little bit about is probably one of the most hyped deals I've ever experienced. So basically what we have done in the past is we don't try to jump in on the IPO. We kind of think that's a waste of time and a bad idea, actually. In the past, we've waited like 6 months. On Amazon, we waited 6 months, and we were able to get the stock for about the same price as it went public at. Facebook, in 2012, we waited about 6 months, and we got it at a discount. So his idea says instead of chasing debut day hype, he advises waiting 12 to 18 months. So 12 to 18 months, 6 months, just wait until there's a period of time where they get through that unlock period where the insiders can do their selling. So if you look at SpaceX, it came out at 135 and it's taken off in a big way. Now it broke down today below that gap up. See, yesterday was what I would call a gap up. So you can see here there's very little history to go by. So I would say the best thing to do on this particular situation is wait for this thing to settle down, consolidate, shoot, it might go to 300, I don't know. But the point I'm making is I think jumping in on the initial pricing can be a mistake, but I've always found waiting somewhat paid off. Let's talk a little bit about the market here. The market's, in a way, it's in no man's land. We've had, for the last 6 months, we've had very strong leadership in the technology stocks, and that's been really where I've been able to make money over the last 6 months. However, ever since earnings reports came out and earnings season recently, the technology stocks are just no longer outperforming. So we're basically stuck in a situation where we don't know if the technology stocks are going to resume their leadership, or is there going to be a new form of leadership that emerges. Again, time becomes a factor. So let's take a look at where we are now. NASDAQ made a high, broke down here recently. We've had about an 8% breakdown held the 50-day. However, we broke the 21-day, which is an important level. Then we rallied, and now as of today, we've broken back below the 21-day. But I would say the other thing that is troubling me is the double top pattern. We have a top, and then we have a double top that failed to break through and make a new high. So we'll just have to see. But remember, we are in a power trend. Now, if we break down below the 50-day moving average and below this low, that would be a little troubling. S&P 500, same thing. We got the top, we got the break below the 21-day, we got the rally, and then a resumption of the break below the 21-day. Did hold the 50-day even a little stronger than the NASDAQ. So, again, the indexes are showing some troubling signs. Now, on the aggression index, which is one of my favorite indicators, you can see here back in the beginning of the year, it gave us a major warning. And we kind of basically gotten a similar warning here. Now, we're dealing again with that double top situation where we need to break through here. So the aggression index is still on a positive pattern because it's above the moving averages. But I would, just continue to say maybe I would keep it kind of light here is what I'm saying. Now, interest rates, the Fed came out today and announced that they were not going to cut rates, and they basically insinuated that they may raise rates this year. Now, the power index, which we've been using for a long time, has shown that interest rates have climbed 14.51% over the last 125 trading days. So this indicator has reliably said the Fed's not going to cut interest rates, and it kind of looks like interest rates may stay up for a while. Now, the primary trend continues to be up. This is your important 200-day moving average. So the S&P continues to be in a primary uptrend as well as the NASDAQ. Now, oil has been in the front page here for a while. We got up to around $112 a barrel, and we plummeted here to $76 a barrel as it appears that the Strait of Hormuz is going to be opening. So the oil stocks are kind of taking it on the chin here. New lows starting to settle down quite a bit over the last couple of days, but we've been having a real high level of new lows, which basically says that the sellers are somewhat in control here. But once the sellers dry up, you're going to see a resumption of below 40 on the new lows. Now, sentiment continues to be very pessimistic, which is positive. That's what you want. You don't want everybody screaming, we're going higher, because that usually forms a top. So sentiment continues to be constructive. We're not seeing any major hoorah, hooray type of attitude. So looking at a couple of stocks, you can see here where NVIDIA, which has been really a leader, has a top here. We've got the lower top breaking down below. Actually breaking below the 50-day, holding the 200-day, but it's just somewhat kind of rolling over look. So it's kind of telling you that maybe the tech stocks are going to take a rest. Now, here is the semiconductor ETF, which is a majority of the semiconductors, continues to actually be in a fairly positive pattern here. So we don't want to be too bearish, but again, I would just say, kind of take it easy here. There's no rush. We are in a power trend. We are in a growth trend right now. The indexes are continuing to look positive. But I will say I'm having a little bit of difficulty finding opportunities right now. So if you have any questions, please let me know. Thank you.